Okay, welcome everybody, and thank you for joining us for another sustainability lunch series. We are very excited for today's topic, and we're very excited to be partnering with the Sloan Energy and Climate Club for today's event. I have a couple of just very quick announcements that I want to share with you all. The first one being another upcoming event that the Sustainability Initiative is hosting, which really spotlights one of our two research projects, which is called the Owning Impact Project. They were able to publish a very exciting investor guide this summer. And so we're going to hear directly from our director as well as the alum and research affiliate that helped pull it all together. So this event is happening later in October, October 30th. And if you would like to learn more and register, all of the information you can find on Sloan Groups. I also want to just mention that I will be rescheduling my sustainability career session, which was meant to happen a couple of weeks ago. I was out with COVID, so I'm just looking for a window of time to be able to offer that session. So just keep your eyes peeled for those announcements. The other announcement that I want to share with students is a request for all of you to complete a very brief survey. Our team right now is trying to understand the confidence levels among sustainability skills as you're coming into the MBA or coming into Sloan versus when you graduate, just to make sure that our courses, our curriculum, our co-curricular offerings are up to par in terms of what we should be offering and how to develop those skills as you're heading into the job market. So we have just a very brief survey here. You don't have to do it now. We can share this post-event, but if you don't mind just taking 2 minutes to complete that, we would greatly appreciate your participation. And the last announcement that I want to make before I introduce our student facilitators is something that we're experimenting with this semester, which we're very excited about. So George Potts is a Sloan Fellow MBA alum. You'll hear from him very shortly. But George is going to be an alum in residence for the Sustainability Initiative this semester. So we're very excited that George has agreed to meet with students one-on-one to explore different areas of climate tech or impact investing based on his expertise and experience. So we're going to be setting up those one-on-one meetings virtually. They'll start being offered later in October. So just keep your eyes open for those announcements, but it's something that we're very excited, something that we can do to bridge the gap between alumni engagement and student engagement. Okay, so let me hand things over to our two student facilitators, Carly and Tyler. They are both second-year MBAs at Sloan, serving as co-presidents of the Sloan Energy and Climate Club. Previously working in renewable project development and consulting, respectively, Carly and Tyler both worked in early-stage VC this summer. They are happy to help support any of you as you explore your journey at MIT Sloan and the future careers you're hoping to pursue within energy and sustainability. So join me in welcoming Carly and Tyler.
Thank you, Jen. I'm glad to see the great turnout we have today. So it's our privilege to help welcome George. We'll start off with a presentation, but want to make this as engaging as possible. So use Carly and I as the means to help facilitate some of the questions and discussions. So with that, we'll kick it over to George. So as a quick introduction, George is the head of Hartree Climate Partners, which is a wholly owned subsidiary of Hartree Partners. Hartree is a proprietary trading and investment house founded by former Goldman Sachs partners. It's part owned by Oaktree Private Equity and Brookfield Asset Management. There, George raised and runs Hartree's Climate Partners Early Growth Equity Fund of $120 million, focusing on climate tech that can benefit from the proximity of their strategic shareholders and partners. It was, in fact, launched in partnership with the Arab Energy Fund. Before Hartree, George completed his MBA right here. He spent 10 years growing a startup private equity fund up to $1.3 billion in asset under management, later serving as director and head of ESG. He built an investment track record in tech-led buyouts and growth equity and chaired the BVCA's Responsible Investment Advisory Group, helped launch Initiative Climate International in the UK, was named a Future 40 investment leader in Europe by Real Deals, and is a trustee at Rainbows for Children. So all that to say, we are absolutely privileged to have George joining us. Please help us welcoming George. George, we can't hear you. You might be on mute there.
Perfect. Is that screen sharing working as well? Or not?
No.
Not quite.
Any good now?
Not seen it yet.
Give me a second. Here we go.
There we go. Yep, we've got you.
Fabulous, fabulous. Well, sorry about that introduction, and thank you, Carly, thank you, Tyler, and Jason, Jem, Emma, for setting this up too. And firstly, apologies for being virtual. I know these are much better in person. I was across just last week for New York Climate Week. I'm across to Saudi and the UAE next week, and then Los Angeles the week after. And with a 4-month-old and a 2.5-year-old at home, I'm not sure that's the best plan with my wife. But I did have the pleasure of meeting several of you on campus last week. So hopefully there are a couple of useful takeaways there, and fingers crossed we can have an interesting session today. As Tyler said, please do shout anytime throughout the presentation. It'd be great if it was interactive. For those that I cannot see, please do interrupt, and fingers crossed we'll get some interesting snippets out. And so really to kick off, a bit of background on what is Hartree. I mean, Hartree is a global merchant trader and investor, proprietary in predominance of its sense across energy, ags, metals. Now, firstly, I'd say that I'm fortunate really to be in a business that has entrepreneurial DNA. I mean, despite the size of Hartree, that DNA is really embedded from the founders, Steve and Guy, who left Goldman Sachs to join Hess Corporation and then ultimately span out with backing from Oaktree just over a decade ago now. And they've grown that business into what is today one of Oaktree's largest and most successful investments, and runs a $12 billion balance sheet. Now, what that meant for me in terms of my joining the business, they looked at their success in environmental products, predominantly carbon. So you would have heard a lot about carbon credits in both compliance markets and voluntary. And they saw opportunity in the private markets, engaged a headhunter and offered me ultimately the chance to invest $50 million off their balance sheet in climate technology companies. Now, at the time, I was fortunate to have a handful of private equity offers simultaneously coming out of a decade in private equity prior to Sloan. And really, the deciding factor for Hartree was really sort of the Rumsfeld unknown unknowns. It was, you had a large trading house that I hadn't really come across in my day-to-day career. They had a lot of physical assets in the existing traditional energy infrastructure, as well as a transition. And they're ultimately owned by Oaktree and Brookfield, who together have $1 trillion of assets under management. And so that kind of optionality, that unknown potential, really became the deciding factor for me in making that choice. And on that unknown unknowns basis came the partnership with TIFE, formerly Apicorp, the Arab Energy Fund, where we stood up together the first $120 million fund that pursues the thesis that I might add I failed to deliver on at MIT. So whilst I was going after my Sloan Fellows MBA, I tried to raise a fund, failed to raise that fund, and ultimately that thesis became what is today the vehicle that we operate together in partnership with TIFE. And helpfully, TIFE, when it comes to the Middle East, a region that is really steadfastly committed to the transition, you have a lot of opportunity coming out of there, a lot of capital potential, a lot of good entrepreneurial activities that we can get behind. And so in combination, it's quite a unique combination, I think, in the market as we see it. So where does that take me into the sort of core content of today? Now, I would caveat everything I'm going to talk about and we're going to speak about with 15 years in, and I'm still no particular expert at anything. I would say, I think I'd like to say I continue to make measured decisions informed by a pretty deep respect for the successes of my own, the failures of my own, the mistakes. The same for others in the industry and other industries themselves. And so quickly on that, before we jump into it, I mean, I learned to fly a plane as a teenager and got my pilot's license, then figured out my eyesight was too bad to join the Air Force, and then became obsessed with air crash investigations, just as you do, right? And seemingly how these small yet cascading failures often cause a tragedy. And then in the inverse, that minor corrections could potentially reverse that and would have ensured success. And so, to quote a wise man, Jack Reacher, really details do matter, and that applies both particularly in the investment world, where there is a big trail before something happens, and you've got to really course correct, course adjust on your route there to try and optimize the outcome. And if you do find yourself with a bit of spare time at Sloan, and I know that's unlikely or across wider MIT, then have a read of the Checklist Manifesto. Atul Gawande, he's from across the road at Harvard, but I wouldn't hold that against him. Matthew Syed's Black Box Thinking. Now, both of those really engage aviation as a proxy for institutionalizing best practice decision making. And so when we think about in business, in life, how to really optimize these things, and particularly when it comes to investments, and not repeating the sins of the past, those two do have some great analogs and really quite interesting insight, which I'd encourage you to dip into. So now, these lessons we go through, they do straddle clearly an investment career. That's to say, I think there is cross-applicability for anyone looking at a new job, new career, new direction, and what you might be thinking about, particularly given the entrepreneurial nature of what I know a lot of people will be thinking in terms of startups, early stage businesses that have venture backing, and so on. And so we'll touch on that throughout. And without further ado, jumping into the first, which I alluded to. So history invariably repeats itself. Now, in climate tech, this sort of typically goes much like the world must. The world needs to do something. The grid needs 500 billion of investments. Shipping must cut its emissions by 50% by 2030 to reach net zero. To meet 2 degrees of warming, we must invest 1 trillion in CDR by 2050. Now, I'm not here to sort of judge, preach, or assess the validity of such statements, nor the institutions that espouse them, but only to comment that in observing humanity and observing rational economic actors, those needs, those musts as they're framed, simply do not traverse Maslow's theory, quite as where those authors would have us want to believe. Yet many do believe in the investment world, and therein emerges the bubble. And why? I mean, really because here comes the market. It's got to meet this need, right? That has to happen. And only the market doesn't turn up. And so whether that's biofuels 1.0, CDR most recently, is it going to be fusion next? I don't know. And not only that, because of the overwhelming kind of market need or humanity's must, the reality of cost curves, your sort of ordinary best practice due diligence, your discipline when you're looking at investments, tends to lessen. The reality starts to bite, timelines go right, costs go up, and they haven't been through sufficient processes simply because that overwhelming market has dominated an investment thesis. And so when they go right, they typically go way right, be that fuel cells or hydrogen. Now, often a trigger for the next phase of that cataclysm is a reallocation of risk. So rates change, policy environment changes, and the allocation to riskier asset classes gets constrained. And ultimately, a lot of people in my profession will then say, wasn't a bad decision by me, this was made bad by the market. Now, that's not quite a valid excuse, and as investors flee, they flee as quickly as they arrived. And so sustainability, aviation fuels, next-gen solar, perovskites, and when investors leave, valuations dip, fundraising suffer, and we enter a standard vicious circle. And I suspect most people know about those in this room, even if John Sterman's made it a hell of a lot more complicated and forced us to look much more closely at the secondary, tertiary, quaternary impacts of that and how they cycle back up too. And I mean, one interesting thing to note along those lines is actually when you get these vicious market cycles, what they do actually create are some explicit winners, because that allocation of capital, whether it's thematic capital or simply people wanting to allocate to a specified space, they start to pursue excellence and say, that is my biggest guard against risk that I now recognize in this market. I wasn't there before, but now it is, and therefore I've got to allocate to the best of the best. And so really, excellence, the best, those assets do rise above the rest in those challenge environments. And in fact, their pricing, their valuations, their ability to raise money actually goes to a bigger premium than they ever were. And that's because the perception gap has widened. So whilst the actual physical reality, the fundamental reality of the difference between that business and these businesses attached to this big market wave hasn't really changed, the perceived gap has increased because the market's come to adjust its view. Now, that is a kind of something to be thoughtful of when you consider investing, when you consider investment strategy. And those companies, as I say, ultimately become an interesting outlier in dire markets because they tend to perform better, they tend to win more. Now, onto my second set of, let's say, fundamentals, which is no regrets moves. And I'd hope this is fairly analogous for career decisions too. Now, hype is something we all recognize. I think we all probably have a sense when it's happening. That doesn't mean we don't get caught up in it. Today, I think, or this week, $6 billion worth of employee shares being sold by OpenAI employees at a $500 billion valuation. I mean, you've got to think those OpenAI employees are pretty smart, and selling $6 billion worth of shares is a reasonable chunk of cash. So I think that that might be one instance where we come to look back and say, maybe that was slightly hyped up. Now, that's easy to say because the challenge within that hype is discerning the signal from the noise and any significance within that signal. And I would simply say that for climate technology investors, whether that's AI or data centers today, try your very best not to confuse hyperbole as the underpinnings of a solid investment thesis. And that typically takes the form over the last boom and bust cycles of, hey, their competitors just raised at X plus one, and this opportunity is only pitching the valuation at X, so this is a great entry price. And look, absent the noise, most often those entry prices are proved not to be so good. And on an investment duration, which in early stage investing up to 7 to 10 years, and buyout land more like 5.5, growth equity 6 to 7, investment duration extends well beyond the hype cycle. And so you've got to be thoughtful about that as you get into these marriages, because they are medium long-term commitments. And luck, I mean, luck can only go so far, and maybe we'll look back and fooled by randomness we were once again, in a kind of Nicholas Taleb sense of, you've got to really think that the fundamentals matter, and you can't be and you won't be excused for making poor decisions that were simply based on the noise in the market at that very time. And so where we really come down as investors is to say that economics counts, and underpinning economics are the most important thing we try and discipline ourselves to look at. So what do I mean by that? Well, 81% of our investee companies operate technology that has a dual use innovation across multiple end markets, at least with one, absent a policy incentive. Now that gives those businesses a fundamental right to exist and grounded in economics, be it cost advantage and diversification. And on that same topic, policy is clearly a big one, particularly in the States at the moment. And I would say that change in an investor's mindset is rarely assumed to be as constant and as in flux as it actually is in reality. And so really disciplining yourself, paying attention to reality might seem a basic concept, but it's often ignored. And as I say, over a duration of an investment with a policy life cycle to this point, it can be something that people confuse as a consistent factor across the period. Now, another that kind of sits beneath that is, I mean, take, for example, the business you're joining or thinking about investing in. I often run a simple test that kind of incorporates what the future might hold and say, okay, what does a mature state business look like to the startup that you're considering investing in? Is it trade on a multiple of profit, revenue, free cash flow? And let's say it trades on 10x EBITDA, and I'm investing in a startup in that space at a $100 million valuation. Then that business needs to be making, ceteris paribus, 10 million profit to break even on my entry price. And I can tell you from first-hand experience, taking companies from loss-making to making 10 million profit is not easy. In fact, it's very, very hard. And so if your scope of win is that constrained and has that much of a challenge before you're even in the money, vis-a-vis what your industry actually looks like at a mature state beyond the noise in the market, that's really something to sense check. That again, the industry can be prone, and we're certainly prone on occasion, to forgetting to have that reality check back to the day one deal, because the day one presents your tram lines for what your range of outcomes is going to be. If the pricing is here, it might be like this. If the pricing is here, then your range of outcomes is here with the same downside clearly. And when I think about policy, I would say that's one element of single point of failure risk. If anyone's had proper sort of operating experience within a factory manufacturing setup, you're typically trying to understand, okay, how does the floor look? Where is one thing that can go wrong that shuts down the entire facility? The US government is going through this process at the moment with rare earth metals, and that is increasingly clear, I'd say, as how it's going to drive the interactions with China, because a quarter of the US defense industry can't operate without what are in fact tiny sums of money on these commodities, but fundamental underpinnings due to their unique qualities that underpin multi-billion-dollar projects that are fundamental to the defense industry. So I would just say there, I've had the same experience of investing in a startup, co-founding a startup where we had one single operational dependence, but that dependence ended up being a noose around the business's neck because they couldn't operate a conversion funnel that worked properly for our business, and we ultimately had to shut down that business. So thinking hard about single points of failure, I think, is always something that we should naturally avoid, particularly across suppliers, particularly across customers. And fundamentally, when we talk about impact, as you do in this class, and as we do in several of the sustainability classes, anything premised entirely on policy, entirely on regulation, is in some sense philanthropic impact capital. And the challenge for that asset class to reach the scale to achieve their end goals is challenging, because you have the temporal element of policy is flux, policy is change, and only economic solutions tend to win at the scale which achieves these really kind of humanity-shifting goals. So what is the solution to that pretty vexing problem? Not an easy one. I think where we try and play is the intersections of what would phrase as collinearity, of saying, okay, well, if there is a climatic impact that is associated with a cost saving, so it's typically, let's say, Sapphire Ocean Technologies, every dollar of revenue it generates is effectively saving emissions while saving cost for shipping operators. That for us is a very neat equation to read across and say, again, all other things being equal, that is a very interesting climate tech proposition, because it's fundamentally underpinned in economics, and we can therefore back that thesis through and be confident in it. Another approach we often see and do quite like is optionality. And what do I mean by that? Or option value. And that is, you have an established core business, but you are looking and saying, okay, our investment, our capital is going to go and pursue that Hail Mary. We recognize that there's a bit of hype in it. We recognize there's policy for support, but we think we're going to get through that cost cycle. But you know what, if we don't, we've got this core business over here that's pretty solid anyway. And so we're going to take that risk. And that kind of investment approach in general is a much more sensible way to play than having everything in that second bucket. Now, thirdly, owning your raison d'etre, your reason for being. I mean, one thing to say off the bat here is owning your own reason for being, but also recognizing others. And so, say perhaps you are thinking of joining as an employee or co-investing with a large corporate. You would be asking yourselves, okay, are their objectives truly the same as yours? Do they align? Do they want to absorb that technology? Do they want to constrain that technology? And do they, in investor shoes, want to deliver risk-adjusted returns to their LPs, to the pension funds that sit behind us? No is kind of the answer. And so a relevant valuation, a relevant vote of confidence for why you're so comfortable joining that business or buying shares in it or taking options in it. Now, that should not necessarily be steered by those kind of entities. And that has historically happened in a lot of the fund space, because they are perceived as experts, whereas in reality, they are viewing this as option value. And theirs is the fundamental, which is their core business, and that'll be absolutely fine, whatever the hell happens to this. So again, it's a kind of mirrored reflection of good investment practices. And I would say that those divisions out of big corporates are typically closed down on cycles. They're then stood back up when the cycle comes back. They change strategy through the cycles, and they consistently do that. So it is often wise to look cautiously at those, to not depend entirely on those entities, but also recognize that strength in numbers is not a saying for no reason. And when you do go through cycles and when you do hit challenges, having that bench strength as an early stage company that you're joining as the fourth employee or investing in that company does genuinely have value to it. Because I say those one-off impacts can impact both fund managers as well, independents, not just corporates. And so having multiple parties backing that early stage company takes me back to, it's often not the quality of the company, but the quality of the consortium that helps the company through, and that proves ultimately out as the winner. And optionality as an entrepreneur raising money, if you're having to speak to 4 investors or you've got the opportunity to speak to 4 investors incumbently, it just breeds value and it breeds opportunity for you to do better as an individual. Now, the second point I would make on owning your raison d'etre is, for want of a better phrase, doing the work. It's walking the floor, testing the thesis, testing the risks. And when I talk about this, it's really about owning the call you're making. And if you ever want a great example, I talk about Hindenburg. So Hindenburg Research, if you Google them, they are unfortunately now shuttered, but they were a rather famous short seller shop. Their research was just top class. Their methodologies were brilliant. They published their results publicly. And Nate Anderson, in running that shop, he really set the bar for owning and taking a view versus lazily wandering in. And in a public markets context, he was a short seller on public stock, is entirely kind of refreshing to see, but equally it's a great reminder for us, as I say, contemplating career decisions, contemplating investment decisions, to really be pretty thoughtful about, okay, what is the understanding I can gain over someone using their computer in this instance? And that is genuinely it. It's picking up the phone, understanding suppliers, customers, competitors, walking the floor, as I say, doing the work and trying to find those examples that give you an edge in the understanding as you're approaching what is usually a high risk, high reward, important juncture in life. And on that note, if you ever do come across a Hindenburg employee, ex-Hindenburg employee, please let me know, because I've been trying to find people and they're pretty hard to find, to say the least, because they got a lot of angst for the work they publish. But I'd love to chat to them. So with that approach, I mean, you do find yourself saying no to pretty much everything. And I've been pushed numerous times in my career to say yes, to invest, right? I've said no, I've stuck with my rationale, and as long as I'm confident, comfortable in that rationale, and I've articulated it clearly, believe it or not, it's still the much harder route to take. Investing, as much as it is glamorized, is execution by and large. It's easy, it's process driven, and once you've done 5, you know where the tram lines are, you know what each party kind of expects, you know where you're going to go, you have a bunch of back and forth, you get a lot of animosity. It's just part of the parcel, because often this is not someone's 5th deal, this is not someone's 10th deal, and so you've got to just go through that process. And so at the end of the day, a glamorized kind of process flow is very different to helping create value, drive value as a board member across a 5-year duration, sell that company, manage a bunch of conflicting stakeholder concerns at that juncture with a whole loss of alignment. That is hard, and that is not comparable to an investment process. So making the time to be thoughtful, to own, as I say, your decision up front versus the 5 to 7 years post-deal when it really matters for your LPs is pretty key. And I'd say genuinely within that philosophy, I've become a pretty ardent believer in the old adage of the best investments are often the ones you didn't make. And that's because there are plenty of opportunities to invest always. I've never found a shortcut to a good investment opportunity, but being patient, owning your own calls when others want you to make the opposite call is really quite a vital muscle to build for young investors, to build in any walk of your career, to stand by what you think is the right approach for the business with a fair and balanced rationale. And of course, being open to change that view should the fundamentals and the facts change. Now, on the way into an investment, either joining an investment fund or joining a company or assessing a company for what they're trying to drive in the business, one of the best ways to figure out really sort of test what they're telling you, how much validity does it have, is how their bonus structure is set up. And so if you find an investment fund that really does remunerate quite substantially on deployment of capital, I would strongly urge you to be quite thoughtful about that entity. I would strongly urge LPs to be very thoughtful about those kind of entities. And likewise, joining a company, understanding how they derive your bonuses, understanding the matrix they use is a piece of due diligence that I would always encourage, because it is the most accurate read through to, does your business plan, does your vision for this business comply with what you are incentivizing people to do and how you're incentivizing people to behave? And that's a key test, again, that is really something you got to try and keep front of mind and have as part of that DD process in big decisions.
George, can I jump in just with a related question on, for folks considering careers in investment, this is something that I weighed a bit over the summer in venture capital. How do you think about kind of jumping into the fund side versus having significant operating experience? And it sounds like you've spent time in both worlds, both on the startup side and the investment side.
Yeah, I mean, I've always been a bit risk averse. So when I did the startup side, I kind of used to, I sort of quasi co-founded 2 companies, but kept my main job. So that maybe that's a reason to have failed. Who knows? I think there's a balance to be had. It really comes to, if you understand what you enjoy sort of early on straight away, and they are different environments fundamentally, right? So being in an operating role in a business is very different to being in a fund and managing 5 different board seats, 3 new investments concurrently, and your kind of day job, and then managing a whole set of different stakeholder challenges within an operating company. So I think first and foremost, it's got to come down to what do you enjoy? What have you experienced, and did you enjoy it or not? I pretty quickly cycled through corporate law, thinking it was a fantastic job, and went and spent 6 months at Freshfields, and decided that is something that I never want to do again. And so that set me on a different path. So I'd say definitely experience it, and you've really got to let that guide you. I think for where that ultimately comes out in terms of a trajectory back into fund management or into startups, I think there are some investor classes, particularly at the earlier stage, that value the operational capability and that you've had experience and you can empathize with startups, you can empathize with entrepreneurs. And then there's a bit of a chasm until you get to much larger buyout houses who want operating partners who have deep experience that they can drop into companies to go and fix things, to launch growth initiatives. So there's no easy answer, I would say, to that, other than they're both excellent experiences to have. But you've got to really understand the company or the fund that you're title. Let's use funds as an example. You've got to understand the fund's kind of archetype that you're going after and see what they employ, how they employ those strategies. Do they have operating partners? Does their founder have an operating background, or they're a pure finance person? Because like it or not, that kind of DNA of the top 2 or 3 leaders is going to be what dictates how they build the firm beneath them. And I would say there's probably fewer. So as I said, there's a lot more at the venture stage that are kind of operating basis. As you get toward the private equity, growth equity into private equity space, until you get to much larger caps, they are much more investment heavy, and therefore you would naturally tilt to that kind of experience to go for that career, whilst giving more of an operational role for the kind of venture stratum.
Thank you.
No problem. And to close that column, I mean, I would say that nothing ever goes right. That is for sure, and that's a certainty in life. And I think that John Stone and I have had a chat about case studies and picking a couple where we put you in the investor's shoes and say, okay, what would you do? How would you do it? What do you think is going to happen? And clearly, we kind of know what's happened. But there are a few rules to kind of live by in that sense. And again, sort of this comes with an ability to be a sort of adopt a kind of Charlie Munger mindset, right? Of expect the worst, and then in general, you can come into a very bad situation and be balanced, be calm, and consistent through what I would say are inevitable storms at any level of investing. I mean, we went from, I was on the board of a business, we were just about to enter an exit process, making 8 million EBITDA, sorry, 6 million EBITDA. And then we got a phone call from the financial controller saying I need to whistleblow, which is never a call you want to get. And the business promptly turned out to be making no money, breached banking covenants, and a week on site in an industrial facility. We had to fire 5 people who were involved in the fraud. The kind of example that things go a bit sideways sometimes, and you've really got to be there next to the people working with those through those challenges, because it's their livelihood, their career. The benefit of a fund manager is you manage your portfolio. Your fund is invested in 10 to 20 companies. For the CEOs, the CFOs, the individuals in those companies, it is their one egg. And you've got to respect that, take the time and dedicate yourself to that, particularly when the going gets tough. And you'll be well respected for that invariably as you go forward. Now, moats is a kind of phrase I like for when I think about investing, because when I look back at the companies that we've been most successful investing in, it's typically because they've built, had, established, or moved into having some kind of moat. And I think when I reflect actually on my failure at MIT to raise the fund, in some bizarre sense, I'm pretty pleased to have failed to raise that fund, because I look back and I think, well, the moats I talked about with prospective LPs that I was looking with in both the companies I wanted to invest in, and then when I talked about the qualities of the fund I was trying to raise, could pretty much be synthesized as trust us, we're smarter than the other guys and girls. And that is implicitly arrogant. That is just not credible. And if an entrepreneur came in and pitched that to me, that same proposal, I would say, no way, and it would be a straight up decline. And what I think we've started to cultivate at Hartree are the unique facets that will contribute to the success of an investment activity, which can fundamentally be defined as deal flow. Can you originate? Can you generate deal flow? Can you win the deal flow you want? Can you diligence that deal flow effectively to price, risk, reward? Can you help create value post-investment? And can you sell it? And so what I put up here are a couple of statistics. And really beyond those, 5 of the 11 investments we've made have come from the platform, not from our team. Nearly 100% of our investments have benefited from some unique angle of due diligence or value creation via the platform, via the battery energy storage assets we operate, via the port infrastructure, solar, nat gas storage, commodities trading excellence, 600 front office researchers, analysts, data people across 19 global offices. And that really, when I step back and assess it, I say, okay, well, that feels to me like a durable moat. And so as I'm in front of LPs trying to say, okay, this is why you should back us even in a tough market. And look, climate technology, energy transition technology is a tough market at the moment. There's no doubting that. You've got to have, I think, that level of inbuilt belief that you've robustly tested. And it's only often sort of in the rearview mirror or with a cold lens applied to it, as I take now to what I tried to do at MIT, that you can really say, okay, was that rational? Was that credible? But when you do find something with what you think is really genuinely a durable edge, a durable moat to competition, go for it. Go for it with 2 hands. Do the very best you can to join that business, invest in that business. Because, as I say, across 15 years, not the longest period of time, but those businesses are rare assets. And if you can get the right things working behind the scenes on those companies, you really can make something quite special happen. Now, I would say, perfect straight lines are rare. I mean, this goes back to setting expectations. I mean, A to B in an investment sense is rarely absent luck. It's rarely absent timing, universal intervention, whatever you like to call it. Now, as I said at the outset, what we try and make is good decisions. What we try and make is the best decision we possibly can, and that's what investors are fundamentally paid to do. Yet, with the best will, you can still miss things, you can still weight something too heavily, you can still ignore a rule, and the consequences can be bad, the consequences can be nil. And the thing with causality is it's kind of borderline impossible to tell what was there. And so we would always typically ask, I mean, one of the sort of favorite questions into a CEO pre-investment is, look, we write a pre-mortem in our investment paper. I challenge our team to say, this fails, why has it failed? Why have we lost money? And I always lay the same challenge at the CEO's feet and say, hey, look, cast your mind forward 2-3 years, why hasn't this worked? Why have we lost all the money? And a few people say, okay, what do you mean of it? Is it the entire company bankrupt? So look, there's kind of range of outcomes there. It's a failure, however you deem failure in your mind. And if a CEO returns that comment with I really can't think of anything. I've never invested in a CEO that says that, because fundamentally to me, it just shows a strong degree of lack of horizon scanning. Because like it or not, I suspect the people who have built the best businesses that have stood the test of time did think about the risks to their businesses. They did think about the competition, and they did think and acknowledge things that could go wrong. Now, that might not be true in 100% of the cases, but a vast majority, I suspect those people were not self-aware enough to be thinking about, to be managing, okay, that is my biggest Achilles heel, and I've got to figure out a way to get that repaired, get that fixed, get that blocked off. And the same goes for investors. Now, as I alluded to at the beginning, successes, failures, they're as informative as each other. And so I would never ignore lessons learned. It's a practice I've tried to institutionalize. When we exit an investment, a lessons learned paper is issued, regardless of its success, regardless of complete failure. A lessons learned paper is issued to say, what did we think? What was actually reality? And what did we do wrong, and what would we do differently, and what feeds back into our checklist? Because we have a checklist at the end of every investment report that says, here are these 15 factors of a business. Tell us, red, amber, green, does it cross any of those borders? Because these are areas where we've lost money before. And if it does, you've got to really explain, okay, why is this situation different? Now, a couple of examples I've thrown out there. Crux Climate, a business where we had regulatory concerns on the way in. It had a lot of policy dependence. The deal was hot. People were clamoring to do it, and the information availability was pretty poor. We made the investment anyway. Where will it go? I don't know. You never know, but the business has raised circa $100 million since from Andreessen, and being the largest VC in the world, you'd hope they probably know what they're doing better than I know what I'm doing. And time will, of course, tell. I think what I can always rest on there is that fundamentally the people in that business, it wasn't for me a technology call, it wasn't for me a market call. It was Alfred has built a business before, a platform business, a kind of unique kind of business model, and you'll see people talk about platforms. And then when you say, how are you going to seed the platform? They'll say, I don't know. And you say, okay, well, yeah, I haven't really thought about your business model then. He built that business, sold it to an Insight Ventures-backed portfolio company, and made a success of it. So even if that went to zero, my core defense internally would be you back the people first and foremost, because they are the absolute determinants of success. And in both bad market conditions, good market conditions, where everything goes wrong, where everything goes right, they are going to be your delta between making money, making a lot of money, or losing money in that range of outcomes. Another example I put down there, Utility Group, so commercial due diligence, CDD. They came back and said, look, the market's 100 million. We think the serviceable market's about 40, and we were buying this company for just under 15 million. And so you kind of sit back and say, okay, well, that's not great if we can achieve 40 million revenue for a business we're paying 15 for. We took a view, we sold it to Accel KKR for 3 years later for 100 million, and that view was proved meritable. Now, the couple of other examples I put there, again, might end up being a couple of the case studies we want to work up in due course, so I won't dive into them. But it's really to say that there's variance here. There's a lot of variance in what you can ascribe to do and what actually happens, and to recognize that as you move through your career, investment, or otherwise. Now, to the final sort of lessons learned element, shall I say, of the presentation, measure outcomes. Now, track your numbers, track what you're involved with, whatever domain that might be in, and have integrity in those numbers. It's very easy, I think, and you're not really joining an excellent firm if someone doesn't push you on the headlines of your CV. If someone doesn't say, okay, well, how did you contribute to that $100 million of sales increase? How did you contribute? How did you make that 5% margin improvement happen? How did you release 50 million of free cash flow from working capital? And if you're not really evidencing that as you progress through your career, well, one, you're doing yourself a disservice. And two, I would hazard that most excellent people wanting to bring you into their business, bring you in as an investment partner, aren't likely to do it because they will push, they will want to understand that detail behind it. They'll want to understand the credibility. And so whether you're an investor, marketeer, CFO, HR director, you take that data with you for a career, you take that evidence base with you for a career. And so back to my opening gambit, learn from those mistakes, learn from the successes, and you really optimize for an outcome, but make sure you're tracking those outcomes, making sure you're documenting them throughout your career, because that is really your currency for how you're building on that hopefully upward trajectory as you go through and go on from a wonderful platform like MIT. So that was my kind of lessons learned section. Happy to take any questions on that as it might be, because I think we then jump into, if indeed there's time, into thematic slides, and there's a lot smarter people than me in the world that know what's going on. So whilst we'll certainly distribute those slides and cover it, I'm equally happy to jump into questions now or cover those, whichever suits.
Great. I think we do have at least one question up front.
Yeah, hi George. Thanks for the presentation. My name is Hao. I'm from Sloan Fellows program as well. So originally from Singapore. I'm not sure whether you'll cover this later on, but Singapore has been signing implementation agreements with various nations over the last few years. Given the turbulence that you've seen in the space with the likes of what happened to Sequest and questions around the trusts of audits in the space, we'd really like to hear your view on the current state of the VCM markets. And you talked a bit about investment philosophy earlier on, wondering how Hartree is kind of navigating the space, and yeah, what's your view on this? Thank you.
Nice, easy question. Thank you. Where to take that little grenade? Those markets were the rationale that I'm in the position I am now. I think what I would say is that having joined and inherited two businesses in that space, the subsequent investments I made had some diversification of interest away from that market. So sustained cert, digital verification, track both carbon markets, but also scope 3 impact and value chain interventions, and Kita and InsurTech in around carbon removal, which when you kind of segment where do you want to be in this space, carbon removal in general is a better, more high quality space to be in because it's better auditable and better for insurance products. And it also had a potential to come through to compliance markets. So I would say, but from then on, I was pretty keen to diversify because it's at the end of the day, the market's underpinnings, if there is no demand in that market and the demand is voluntary, and so if there's ever any pressure on an industry, on profits, on reputation, that gets chopped. It has been chopped. And so what I would say is for a kind of $1 billion market in a voluntary sense, there's kind of never been so much noise about such a small market. There's a lot of, and a small market comes with mixed actors. It comes with bad actors. It comes with good actors. And the intention that's shown on a very small market, which if you did put it on any market, I'm pretty sure at that size, you would uncover some bad eggs, and that certainly happened. I think that's probably helped drive a bit of accountability, a bit of credibility into the market through flushing that out. But equally, it's put a lot of people off doing some good work. And I think that's a shame. That's disappointing from an impact perspective. I would prefer that market was flying. I think we should all want that market to be flying because it does a lot of good work around the world. When it's done right, and long term, maybe this cleansing will kind of help that come back. But I would say that we see that as I think we see that unless you're in the top quadrant of high quality projects where you've got that accountability, that credibility, and you can expressly make either government to government transactions like yourself with Singapore leading the way in quite a number of those, or sell to high quality corporates through the credibility of your product, you're not really going to find a way back into this market. I think it's moved to a much more professional state in a large part, and those are the ones that are going to see some of the volume. And primarily, our interest from a capital perspective is right there on the compliance markets, whether that's NZUs in New Zealand, ACUs in Australia. Therein lie opportunities to build projects, to build impactful projects, but also know there's a price, know there's a buyer. Because if you can't know there's a buyer and you've got a higher cost of capital than you ever had, it's kind of a hard space. So I appreciate that's a windy mix, not really kind of more of a politician's answer, but it's a hard one to give a fixed response to or an absolute view on.
Thank you.
We have a question online. When do you think climate tech will have its ChatGPT like breakthrough moment that changes everything in line with power law returns?
I think it already has in solar. I mean, what solar is doing is not to be misunderstood in the wider noise, I would say, about climate technology. And solar is transforming the global energy landscape at a rate that has never really been seen before. And so I would say solar is that technology. Solar is the quasi-semi technology of the climate technology space, and that has had the most global, powerful impact of any of the technologies to date. Will there be another? I hope so. Is there one that I could point to today and say potentially? Solar and batteries in combination is going to be a very powerful feature of the market and our lives in the future. And the intersection of AI, right, which to some degree is overblown. When I say to some degree, to a severe degree. But at the same time, algorithmic optimization, focus on efficiency, focus on cost. These are age-old, what was just called machine learning back in the day. That is still an area of big interest, but I don't think it's ever going to have, or it will have on a global level, sensors, IoT tech. Someone might not call that climate tech, but the industrial base of the world is moving quickly in that direction. You look at the likes of Emerson and what they're doing, what they're achieving in facilities. So kind of everyone talks about this big load growth element, right? Okay, ChatGPT, data centers, AIs, we're going to require 10% load growth in the US. I mean, let's see if that comes through in the data. Again, beyond the hyperbole. But businesses like Emerson, the technology they're building into facilities like data centers, like industrial operations through sensors, through IoT, they're achieving 5 to 40% savings and optimizing efficiency and outcome and production runs. That movement isn't going to not be insignificant. So whilst it might be quiet, it might be boring, and it might not attract any headline, it won't attract any headlines. That for me is a very interesting space because that is happening. That is real quantifiable impact. It is underpinned by economics. And it's a great place to be, and it's where we've just put a chunk of our capital, 10% of our fund into in our last investment. So yeah, that plus solar, I would say.
We had and I think
Online is asking, how about fusion?
Yeah, how about fusion? I mean, how about it, right? I mean, it's 5 years until I think we get net positive power from Commonwealth Fusion, which is the kind of leading entity. So I'd say that's at some distance away until we have a success in that space. It takes a lot of capital. Is that a space for venture money? No. Is it a space for philanthropic capital, for large family offices, for people that want to impact the trajectory of the world? Gates, Bezos, absolutely. Should governments be there? Absolutely. So yes, I think it's going to happen. Will it be on a 15, 20-year timescale? Most likely, because not only do these technologies have to get to a point of producing net positive power, they then have to efficaciously compete with a commodity product, which is power. And so you're going to have a lot of improvement in solar in between now and then in the quality of solar cells. You're going to have a lot of improvement in batteries. And so there is going to be a natural level of deflation, I think, from competing power sources. And this is why sort of the resilience, I think, the discipline of being in a commodities house where you think about things like commodities and where you think about, sorry, my daughter's banging on the window. You can come in, darling, if you like. When you think about where do these end up, that's kind of forward test, right? Give me plus 5 years. What is it competing against? It's competing against your standard utilities. It's competing against a boring solar plant. It's competing against a boring coal-fired plant. It's competing against combined gas and power. just because it's sexy today and it's novel doesn't mean it doesn't compete with those industries. And those industries trade on 6 to 9 times EBITDA. And so if you're investing in a fusion company at a $2 billion valuation today, that's going to need another 6 billion of capital before it produces 100 megawatts of power. I find that challenging to stomach as something that I would represent as the right decision to my LPs. I'm not saying it's the wrong decision for countries, for governments, for family offices, but it's not a place that our funds will play in.
Maybe for the benefit of the students we have in the group, I think the lessons learned are incredibly helpful as we think about careers in the space. Could you talk a little bit maybe about what brought you to Sloan, doing the Sloan Fellows MBA program? What was it about the program, the classes, the clubs, the events like this that you've now kind of looking back, pull those knowledge bases out every time you're in a meeting, you're in a pitch? Kind of how did you best use your time, as we have a lot of first years who are thinking about how to spend the next 2 years here?
Yeah, absolutely. I think you can, the old drinking from the fire hose piece, right? People always love to say that, and I was like, okay, well, yes and no. At the same time, you're in a wonderful part of the world. The East Coast is brilliant. The US is brilliant. And so I would go anywhere and everywhere every weekend. And so first and foremost, treat it as a great place to be and a great time of your life. And my wife and I certainly made the most of that. Secondly, you can take a view of I will do as much academic study as possible and fill every kind of minute with that. I took a view of I will do what I need to get my degree, and I will try and raise a climate tech fund at the same time and also have a fun time and play some sport. So I think you got to kind of be thoughtful about this as a finite period and actually cast your mind forward 5, 6 years. Is taking those extra 3, 4, 5 lessons, units, whatever it might be, really the thing that's going to have kind of differentiated you at some juncture, at some moment when someone was choosing between you and someone next to you? My gut says probably not, but what might differentiate you? Were you volunteering with something? Were you working, or were you interning with a company? Were you working on an idea through that period that was unrelated to your coursework? Because everyone ends up with the same degree in the same sense of the same class. So I would really kind of encourage you to be pretty thoughtful about dedicating yourself entirely to academia. It's probably not the right MIT kind of catch, but anyhow, that would be my personal advice. So I think those 2 elements are pretty key. And then thirdly, the connections you make both at the institution level and both in the people that are there, right? The cadre of people around you. Unfortunately, you're never going to encounter that again in life. So kind of get ready for that, but make the most of it in terms of the friends, acquaintances, professional, and otherwise that you can make whilst you're there, because that is really a lasting network, and find those elements that you can hang on to, work with, hopefully more in the future. Through the Climate and Energy Ventures course, I'm now an investor in an MIT spin-out in Cam Halliday at Mantle Capture. Cam's an incredibly bright guy, inspirational guy from a course I was on him with, and so you kind of never know when those intersections are going to come back. But if you put yourself out there, you can find interesting people. I'm an investor in Robigo, Andy Wallace out of MIT again, doing fantastic things in and around crop protection. And if you can meet those people, you go around to their facilities, see what they're doing, and they're just inspirational stories. So if you've got a skill set, if you've got something, even just optimism, enthusiasm, put yourself out there, find these people doing interesting things, find the professors who've just got a grant to do something, and offer yourself as a free resource. And you're going to learn something, you're going to get something tangible out of that. And that is going to differentiate you and your worldview, more importantly, and what you bring to the workplace or the venture when you next come to it.
George, I think we have 1 more minute. Couple more minutes. I had one kind of burning question for you, which I'm very curious about. As a climate leader within a larger organization, do you ever find your goals sort of at odds with other business leaders, and how do you handle that challenge?
Only in the sense of capital allocation. So again, we're an institution underpinned by economics, and we will allocate capital to where we perceive the best returns to be and the best opportunity for our shareholders, which is Oaktree, and which is the partners of the firm, and ultimately its employees. So I think allocation of capital, sort of, you constantly got to prove your business case, which I think is a good discipline to have in general. Certainly a lot of the public sector could kind of use that kind of discipline. And I think that's a kind of unique facet to trading houses. I think in the sense of what's the sort of the question that sort of traditional energy versus energy transition. In a shell, that is a more complicated question. In our business, it's a lot cleaner. Particularly now we operate the first fund. It has a dedicated mandate. That mandate is enshrined by our LPA. And most generally, these companies that we're introducing to people that we find, and we say, look, do you think this is an interesting technology? Could it work with our gas peaking plants? And could it improve the efficiency of those plants? That's a beneficial, sort of welcome conversation. People like hearing that. They think, okay, I can integrate some technology into what I'm doing that will improve the returns. And again, that mindset I find pretty conducive to helping us do our job as well as we possibly can.
Last question. Who wants the final word? All questions answered. Well, please join us in thanking George for his time. Really appreciate it.